Hi, I'm Michael Davin from the Department of Accounting. Today I want to talk to you about management accounting. Management accounting information supports decision-making by stakeholders internal to an organisation, such as managers and other employees. As internal stakeholders, they can demand the information relevant to the decisions they have to make, so they have no need of the protection of regulations and accounting standards to drive appropriate accounting judgments. So what sort of decisions do these stakeholders make? Let's return to Barry and his coffee shop from our earlier videos. Barry has a lot of business decisions he has to make in managing and operating the business. There are operational decisions to make, for example, pricing of products and determining the profit maximising mix of products to offer. Such decisions are obviously heavily influenced by external factors like market competition, but understanding the cost of products or services sold is also critical. At the operational level, management accounting has a strong focus on measuring and controlling costs. Management accounting is also forward-looking and helps with planning. For example, through budgeting and monitoring performance to ensure that plans are realised, or to prompt adaptive actions when necessary. Consequently, management accounting informs decisions and actions in the business from strategy through to operations. Let's explore this further. How much does it cost Barry's Barista Bar to produce a cup of coffee? To address this question, we need to understand the different types of costs involved. Accounting distinguishes costs along two dimensions: the behaviour of the cost and the link between the cost and what is being costed, or in technical terms, the cost object. Importantly, these two dimensions are not mutually exclusive. Let's look first at the link between the cost and the cost object. Direct costs can be clearly attributed to the cost object. So, for example, the cost of labour that goes into making a cup of coffee can be directly linked to a specific cup of coffee. Indirect costs, on the other hand, cannot be clearly attributed to the cost object. For example, the cost of repairs and maintenance of Barry's coffee machine is obviously part of the cost of producing cups of coffee. However, it's difficult to determine how much of the cost of repairs and maintenance can genuinely be attributed to the production of a given single cup of coffee. In terms of cost behaviour, we can distinguish between fixed and variable costs. Total variable costs increase with volume of production, but per unit variable costs are constant. For example, for a given type of coffee, the total cost of ingredients used goes up the more cups are made, but the cost of ingredients per cup is constant. By contrast, total fixed costs do not change with the volume of production, at least within the relevant range. For example, the rent for the coffee shop premises doesn't change whether Barry sells 1 cup of coffee or 1,000 cups of coffee. Of course, at some level of activity, Barry will need a bigger coffee shop or an additional location, but such a situation is outside the relevant range, both in terms of volume and time period. In practice, some costs are neither clearly fixed nor clearly variable. Volume is also not the only factor with which costs may vary in the short term. In technical terms, we say that volume is not the only cost driver. Unsurprisingly, classifying costs requires judgment. And as we consider a broader range of cost behaviours and drivers, these judgments become more complex, particularly as we move beyond the context of a small business like Barry's Barista Bar. Understanding the relationships between fixed and variable costs can help Barry's decision making. For example, in the short term, even if selling a cup of coffee is not profitable, he should still keep selling if there is a positive contribution margin. That is, if the sales revenue is greater than total variable costs. Or in per unit terms, the unit selling price is greater than the variable cost per unit. A positive contribution margin helps pay the fixed costs, which by definition can't be avoided in the short term. By understanding the relationships between sales, cost, volume, contribution margin and profit, Barry can work out, for example, how many cups of coffee he needs to sell to achieve a given level of profit. This cost volume profit analysis, or CVP analysis, is useful for operational level planning and decision making, particularly as it permits different scenarios to be explored through what-if analysis. For example, what if competition forced sale prices lower, or a supplier raised prices and variable costs were higher? Will the business still be profitable? How many more cups of coffee need to be sold to ensure profitability? CVP analysis can also support strategic decisions, like the viability of a proposed new business location. Budgeting is a management accounting practice aimed at planning. At the top of the organisation, the budget is a statement of the strategic plan for the business. This is then broken down to lower level budgets, ultimately down to budgets for the day-to-day operational activities that are to be carried out to meet the strategic goals of the business. Budgets serve to communicate the goals and plans of the organisation down the hierarchy and coordinate the different activities of the business to ensure those goals are achieved. In a small business like Barry's Barista Bar, the budgeting process is obviously going to be relatively simplistic, particularly compared with a large corporation. In part, this is because Barry can communicate goals and strategy to his employees directly, and also directly coordinate the different activities of the business. Nonetheless, Barry will want to develop budgets as a means for planning for business success. There are a range of different budgets that can be developed, from sales budgets, cash budgets, labour budgets, and so on, that can all be aggregated together in a master budget. These budgets help Barry ensure he has all the resources of the business available when needed, and that resources are effectively utilised. For example, the cash budget helps Barry plan to ensure that he has enough money to pay bills when they're due, but also that he doesn't have excess uninvested cash resources lying around. The labour budget helps ensure the barista bar has enough staff to serve customers, but also avoids having to pay wages to staff who are not needed. Budgets aren't just about planning, they're about control, ensuring that the business and those who work for the business meet goals and targets. By monitoring performance relative to budget, Barry can be alerted earlier if the business is not running to plan. By understanding what is driving this budget variance, Barry can take appropriate action, whether that is a remedial action to get back on plan or a proactive response to seize an opportunity if the situation is unexpectedly favourable. Budgets also provide a target for motivating employees and a benchmark against which their performance can be measured. For example, Barry could set sales targets in the budget for the employees of his coffee shop. He may even have bonuses for achieving sales targets to motivate even greater effort. Performance reporting, whether budget-based or more broadly, is a major activity in management accounting. Determining how best to measure and manage performance to achieve strategic goals is complex. This is an area of substantial ongoing research in accounting to improve performance management practices from the factory floor to the CEO. In summary, we can see that management accounting supports decision-making from strategy down to operations. It enables businesses to plan for success, to understand how much it really costs to deliver to customers, how those costs link to products and services, direct versus indirect costs, how costs behave, fixed versus variable costs. Management accounting thus enables the exploration of different what-if scenarios. Management accounting also reports on performance, ensuring business units and individuals are meeting target levels of performance. It enables a business to actively manage its journey to success.